Thanks for joining us this week. I'm Stewart Willis, and you're watching the Asset Preservation Hour. Look, 2025 is behind us here, and now we've got to start thinking about 2026 and New Year's resolutions. What action are you going to take to make sure you have a better retirement? Well, it's time to take action now. Guys, 25 was a ride, wasn't it, Dan?
It was fun. It was fun. Lots of ups, downs. You know, we had the tariffs. We had a whole bunch of stuff going on. Whoever didn't get excited about 2025, I don't know, you must have been asleep in general. But we had a good time, didn't you?
No, look at one gray hair, man. One.
Hey, at least yours isn't falling out.
Yeah.
Hey, look at no hair. Hey.
He's like the Ronald Reagan. I can guarantee you that hair is not his natural color. that is a color that I don't see in human nature there. So, guys, all right, 25, it was up and it was down. It finished up in double digits, but a lot of people don't feel it. A lot of people are feeling negative about 2025. Why do you think that is, Eric? What do you think's happening here?
When is it going to fall, right? When's the stock market's going to fall? It can only go up so much, right? No, in theory, you know, what goes up must come down, but we're in a different world, right? It doesn't feel like we're doing as good as the news tells us we are, because everything's more expensive. Even though inflation is coming back down, the grocery inflation is still there, right? So I have clients who are doing well themselves, but then they hear struggles that their kids are experiencing, stuff like that, so they don't always get to feel that.
So let's dive into that. It's interesting to me. So in a previous conversation, you and I discussed the K-shaped economy. So explain that to me, because I'm feeling good right now. I'm feeling the markets are up. You know, people are generally feeling good. But not everybody.
Yeah, generally everybody's doing fine, right? But long story short, with the K economy, so look at it, right? It looks like a K, right? People that have assets, the haves, right, and the have-nots, feel like, you know, as the stock market's doing well, they're getting wealthier and wealthier, whereas other people that may not have the ability to own assets because they're just getting in, you know, out of college or whatever the case may be, their dollars aren't stretching, so it feels like they're going the opposite direction, right? Personally, my family's being impacted by this, right? So what you start to pay attention to is how do you address the concerns of those building wealth, but also how can you help your family? Now, that's the number one concern I'm seeing with clients is I'm okay, but I want to make sure my kids get set up for success going forward. And so the wealth transfer strategy is becoming more and more of a prevalent topic in our conversation.
Got it. So, well, I think wealthy people historically have stayed wealthy because they plan. They think about the next generation. And look, it's not right or wrong. Some people say, hey, I'm not passing any money to my kids. I didn't get any money. And that's their prerogative, right? But when it comes time to efficient planning and passing money efficiently, I think a lot of people want to make sure they have that kind of a plan. But look, looking back at last year, 2025 was crazy. We felt it mainly in our tax season in April during the tariff conversation, Scott.
Yeah, busy time, really busy time. And just adding more fuel to that fire during a real busy time, an uncertain time. Then the market's going up and down. And then clients are considering, hey, am I diversified where I should be? Should I make some changes? Should I capture these gains? Should I not? It was a pretty tough time.
But I think that's why it's important to have a plan, to make sure that you know where you stand, that you're taking the appropriate amount of risk for yourself. And I think there's still a lot of confusion over a lot of the changes that we saw last year in the Big Beautiful Bill, for example. So Dan, when it comes to the Big Beautiful Bill, what is the concern? What are people confused about in terms of the difference between reality and what's in their mind?
Yeah, I got a lot of clients that are coming in and they're still thinking the Big Beautiful Bill was all about, President Trump coming in and making sure that Social Security was no longer going to be taxable. And, you've been saying forever, there's no way that he was going to be able to get that through, and you turned out to be right.
I think it's the one campaign promise that I didn't think he could deliver. I mean,
for sure.
He's pretty much done what he said he was going to do.
Yeah.
That's the one place where he came short. But listen, it's no surprise. I even, when he's campaigning, not going to happen, not going to happen. It's too much revenue.
Yeah.
Congress, It's a drug.
Yeah.
It's just give me more, give me more. They never let go of it, and that's one of the places I knew wasn't going to happen.
Yeah, it caused a lot of confusion. I mean, a lot of people are still, standing back saying, well, what exactly did it do? And am I getting 12,000? Am I getting 6? Is it per married couple? Is it individual? There are a lot of things that happened. And then, you start dealing with all the other rules, whether or not your state, has SALT, as far as the state taxes and everything else. And there's a lot of things that were like kind of thrown into that overall bill. So it's kind of dissecting it and getting a better understanding of what it means and what it doesn't.
To you specifically.
Yeah, especially, I mean, certain things are permanent, quote unquote, right? Could be erased later. But certain things expire in 4 years, right? So the biggest one was this senior deduction or bonus deduction that people get. For those over 65, if you meet the criteria, you get an extra $6,000 that you're able to take as part of your standard deduction. But that goes away after 2028, as well as
and there's
no tax and
phase-outs
tips.
for there.
Yeah.
There's phase-outs for there at $150,000 for married
For a married
certainly.
couple, yes.
Yeah, or $75,000 per person. But let me ask you this question, Scott. Listen, I know you're in our Peoria, Arizona office where you and Dan get to run the headquarters there. Erick is, of course, out of Scottsdale. And you may see different ways of thinking. People think differently in different locations. But there, in Peoria, what are you seeing that are people's concerns specific to the big, beautiful bill?
I think, well, one of the things I was hoping to see was an adjustment to the provisional income calculations.
Oh, yeah, good luck.
That's
Yeah, here
very,
we go again. Okay.
at least adjusting for inflation, or even a little bit.
Okay,
would have been nice.
so just for the audience, I want to clarify what provisional income is because there's some I like to stay away from jargon, but every once in a while we have to use it. So provisional income is a calculation used to determine whether you pay tax on Social Security. And it hasn't been adjusted for inflation ever. So it was set back in 1983. Then they made Social Security more taxable in 1993, but those thresholds have never changed. So a tax on Social Security, which at that time was supposed to be a tax on the wealthy, by not adjusting for inflation, it went from a tax on the wealthy to eventually a tax on the poor. And provisional income adjustments. If they would have adjusted that for inflation, that's a whole different ballgame that we're in right now, right? So, I mean, is $43,000, is that wealthy to you if you have $43,000 of income, Dan?
Well, not in my standards. I mean,
That's your horse food.
It is. Those girls and their horses. Yeah, the expense of that. No, I mean, 40-some grand. It's crazy when you stop and think about it. Like that back then, they thought that you were rich at that stage. And I mean, that would be like poverty level at these days, right?
Yeah.
So,
well, it is. I mean, and that's the point, is that it's lowering the thresholds. And when it comes to this here, when it comes to the big, beautiful bill, I think that there's all this guesswork. There's all of these people guessing on how it's going to affect them specifically, and they're just guessing. At the end of the day, the big, beautiful bill will benefit a lot of people. But what you do not want to do is be penny wise and pound foolish. Okay, when we start doing tax planning and look at things like Roth conversions, I had clients this year that said, hey, I don't want to give up my big, beautiful bill deduction, the $12,000 deduction. But if you could save, and I'm making this number up, right? If you could save $500,000 in taxes for the rest of your life, does it make sense to worry about a $12,000 deduction at a 12% bracket? You're talking about a few $1,000s here. You're not talking about hundreds. And
No, right.
it's like Irma, right? I talk about it all. Irma is the Medicare penalty that makes people crazy.
Yeah.
Crazy. I had a client, Mary Jane, I won't say her last name. She knows who I'm talking about. She went to our congressman, had him reverse it. He got involved. They reversed it. They made the argument. And you know what? She got it done. But guess what? Since Social Security's ignoring it, we're 9 months later, and she hasn't gotten a refund from Irma. So what you don't want to do is be penny wise and pound foolish. Sometimes you have to take the hit now. Taxes are on sale now. Sometimes you have to take the hit now to make sure that you can have a plan that makes sense for the rest of your life. And oftentimes your feelings about something get in the way, which is why we rely on really sophisticated software to do this sort of planning. And Erick, when it comes to software, on the tax side, we use Thomson Reuters UltraTax, which by most standards is the best tax preparation and tax planning software. From cash flow, we use, of course, eMoney, which is the the top of the food chain there. Why do you use eMoney, and why does it help you with your clients?
A lot of it has to do with let the numbers speak for themselves, right? So I tell clients, hey, there's only certain variables that we can control, right? What we make, what we choose to take from our portfolio based on what we need. But one of the biggest things is what I look at is if we forecast you out today, assuming we don't change any of your tax strategy, what that software allows us to see is here's what your tax bill is going to look like possibly, in the next 20, 30 years. And with us either improvising, or changing how your cash flow is being distributed, how you're doing Roth conversion or not doing conversions, we're able to see the net impact with an overlay. Hey, you're saving money on taxes and increasing your net worth, right? And so I always tell my client, let the numbers decide what we should do. I don't know what tomorrow's going to bring, but at least we have an educated guess here based on what the data is saying on what direction we need to take. And
so there's no universal truth.
No, there's no universal truth. But different. The universal truth that there's always going to be taxes, there's going to be death, and I think taxes are going to go up at some point in the future.
Well, people are living longer too, so maybe we can prolong death as well. But look, if you want to find out how a financial plan that also has a tax plan, how that can benefit you, and you're not getting that today, then you need to ask for help. I see it all the time. People will come up to me. I'll be at one of my kids' basketball games or, out in public, and they'll say, hey, aren't you that financial guy? And I'll, yeah, I'm him. Hey, I've been watching your show for years. And I said, well, why haven't you called? And they said, well, I feel weird calling a television show. Here's what should be your New Year's resolution. Whether it's with us or somebody else, take action. You know you need help. You know you need a tax plan. We were given this blessing, whether you love Donald Trump or hate Donald Trump, I don't care. The big, beautiful bill extended the Tax Cut and Jobs Act. We have been given at least 4 more years under this tax provision where taxes are on sale for the middle class. You need to take advantage of it. So if you have a financial plan that doesn't include a tax plan, we are offering you an absolutely free review. But make it your New Year's resolution to start taking action, not just talking about it. Take action today. Pick up your phone, give us a call. We'd be glad to help you. If you give us a call at 833-602-PLAN, once again, that phone number is 833-602-PLAN, or even easier, if you pick up your phone, click on the QR code, that'll take you to assetpreservation.com. There you can claim your absolutely free review. We'd be glad to meet you in our Tempe office, in our Goodyear office, Gilbert, Scottsdale, Peoria. We have an office near you. There are no excuses. Make it your New Year's resolution to take action today. And when we come back, we are going to talk about the difference between tax preparation and tax planning and why you need a tax plan in your life. Don't go anywhere. We'll be right back.
If only we'd taken charge, we really could have been living large.
But in 2025, we missed the boat. Now we can barely stay afloat. 2025 was a year to score. The greatest tax break in American lore. The window was open.
We knew it wouldn't last.
We told them to act real fast.
Remember the Joneses, those sneaky devils who seized the tax moment at whole new levels.
And what about those pesky Smiths? Well, they're off on golden sand. But here we are with a staycation planned. They said, invest, retire like kings, but instead we focused on other dumb things. Oh, if only we could turn back time, we'd take advantage of every dime.
Act fast and take control of your financial future with Asset Preservation Wealth and Tax today. Welcome back to the Asset Preservation Hour. I'm Stewart Willis, and now it's time to talk about the importance of tax planning. And where we're going to start today is gifting and donating money. So a lot of you are charitable. Some of you are not so much. You, I don't think so much, Scott. But me, I'm okay. No, listen, hey, keep your money, give your money, it's on you. But where a lot of tax planning starts is by efficient gifting, efficient planning, efficient donating in the most efficient way. Now, when you turned 70 and a half historically, you had required minimum distributions, and that age has now risen to 73 and will eventually go up to 75. So when you put away money into IRAs and 401ks, Uncle Sam says it's now time to pay. But there's a little secret. there's a little trick for those of you, especially those of you that tithe to your church or donate money to charities, and you're giving away money, you're donating money to these charities. A lot of you are wasting your money in this sense. You're donating money thinking you're getting a deduction for it, but here's the problem. You're taking money out of your IRAs, and then with separate money, you're donating money. What you're allowed to do is something called a qualified charitable distribution, a QCD. Now, Dan, let me ask you, are QCDs popular in Peoria?
Well, sometimes, quite frankly, a lot of people don't understand them and don't know what they are. And so it's really important to make sure you understand. You've got a large dollar amount in some cases, and people don't need that money. And so why wouldn't you just take it out of your account that you're being forced to actually put money into? And so the RMDs, required minimum distributions, you have to start taking that money out, as Stewart had explained. At 73, it's going to eventually be 75. So if we can take that money, and once charitable, always charitable is the saying, we want to give that money to the church, donate a nice little organ so I can help play for it,
Oh, gosh. If you guys want to see him play at his local church, go join Dan at his church.
No, but seriously, QCDs are really important that you can take that money now and you can actually donate it, and you're not pulling from multiple resources. So by taking that money out of qualified funds, and now you're giving it to your church, you're giving it to the local YMCA, whatever sort of charitable contribution you want to make, that getting pulled out of your actual qualified account, the IRA, really makes a lot of sense.
Yeah, no tax on the IRA to you and no tax to the charity.
It satisfies the RMD.
So it
But
satisfies-
aren't you messing with the charity by giving them this taxable consequence? I mean, this is a softball.
I wish I was a charity. Yeah, I don't have to pay taxes. They don't have to pay taxes.
They're
on it.
501c3s. They're
501c.
nonprofits. They don't pay taxes. So when it comes to this stuff, this sort of gifting, I think especially we see it a lot with the tithing communities in the church that are just completely doing it the wrong way. There are more efficient ways to do that. And if you need help, let us know. Now, listen, when it comes to donating money, that's one thing. But what about gifting money, right, to the next generation? Some people want to actually see their heirs enjoy their money during their lifetime. Others could care less. But for those who actually want to make sure that they can see their kids or their whomever enjoy gifting now, enjoy the fruits of their life's work, what's a good strategy to help that?
This basically, you're allowed to gift stock, right? And so there's gifting exemptions, currently $19,000, right? And so what that allows you to do is instead of you cashing out stock and you paying the capital gains on highly appreciated stock, you're able to gift stock directly to your heirs. And if they sell or when they sell, they pay the taxes, not you. And so that opens up a window for you. So instead of you taking the tax hit now and potentially impacting your IRMA, your Social Security being more taxable, or just overall tax strategies if we're looking to do Roth conversion, it leaves that
IRMA
room.
is the penalty on Medicare.
Correct, right? And so by you basically deflecting the tax or gifting the tax to someone else, sounds bad, but my kids, when I ever gift them stock, if I ever gift them stock, they're not going to complain about the tax on money they didn't earn.
Right.
But I'm using this strategy more and more because Nvidia has gone through the moon, right? So other stocks have gone up in value substantially, and it's a way for you to be able to help your kids transfer wealth so that they're able to be here while they're enjoying their inheritance, and then they pay the taxes, not you. And so that just opens up more window for you to enjoy your money more, or just do Roth conversions, or take advantage of tax strategies that now are on the table for you.
Got it. And if you're donating, for example, people that have purchased highly appreciated stock that are also paying big dividends, it also sounds like a way to get those dividend producing stocks out of your income stream and maybe into the kids who may have a much lower income stream or income tax bracket than you. I mean, everybody's situation is different.
They might need it more, right? That's a wealth transfer strategy.
Yeah, sounds good. Well, listen, I think everybody has a different solution for themselves. Everybody's situation is different. There's no one size fits all. I think, though, it's really important to make sure that you're not being penny wise and pound foolish. One of the things we talk about with tax planning, we always talk about the Roth conversion. When it's time to move your IRAs and 401ks into a Roth, but Scott, I see it all the time. People are penny wise and pound foolish. They end up not wanting to pay to move from a 12 to a 22% bracket hypothetically,
Right.
for a year or two to make sure that they're tax-free for the rest of their lives in many cases.
Right.
Why can't people just pull the trigger, pay the tax bill now? It seems painful to them.
I think it really is just having them wrap their mind around the math, right? If you just look at the math, initially it feels like it's going to be a little bit of a pain, but the math doesn't lie. I mean, you're going to end up saving all that tax-free growth over time. And having a good strategy and implement it into your overall portfolio holistically, it's a good argument to take advantage of these brackets that we have today.
Well, Erick always talks about, paying tax on the acorn, not on the oak tree, right? If you do it early and let it grow over time, it'll grow into this amazing. Listen, one of the greatest Roth conversion stories, or Roth stories in general, is the Peter Thiel example. Peter Thiel, they call him the Lord of the Roths. If you don't know what I'm talking about, go ahead and use your little Google machine. You like that, Google machine?
I like that.
Go ahead and Google the Lord of the Roths, Peter Thiel. And basically, he used all this money that was inside his plan, and it was a Roth. And he used his IPO money, I think it was from PayPal, and that money is now like $5 billion tax-free. It was a few $1,000s of contribution that went through the roof. Now it's $5 billion tax-free. Congress is mad that he never had to pay tax on this money, but you can use the same exact strategies that some of the wealthiest people on the planet are using. But you have to use it to your advantage to make sure that you have a tax plan that doesn't just work, for you now, but will work for you for the rest of your life. And if you want to find out if a tax plan like that makes sense for you, we're offering you an absolutely free, no cost, no strings attached tax review and estate review. All you have to do is give us a call. Take action today. Give us a call at 833-602-PLAN, or pick up your phone, click on the QR code. That'll take you to assetpreservation.com, where you can claim your absolutely free portfolio review and tax analysis. But you have to take action today. When we come back, we're going to talk more and more about 401ks, thrift savings plans, and how to take advantage of your current work plan. Don't go anywhere. We'll be right back. People are really concerned about outliving their money. Inflation, taxes, volatility in the markets, legacy. That's what people are really concerned about. Listen, I love what I do. When a client of mine can know with total confidence that they're going to be okay. At Asset Preservation, that's exactly what we do. Not only do we look at your investments, we look at your taxes and estate planning as well. We don't leave any stone unturned. That is what a real holistic shop does. Provide a very clear roadmap so that you know it's okay to enjoy retirement. Success is being able to sleep at night. And at the end of the day, what we provide at Asset Preservation is not only the market expertise by institutional money managers that are some of the biggest and best in the world, but we also provide complete advice. You need to make sure you have a plan. What you can expect from us is to let you know the truth about your portfolio. Welcome back to the Asset Preservation Hour. Now we're going to dive right in to 401ks, thrift savings plans, and other work plans. So Dan, let me start with you here. When it comes to these plans, I hear all the time, I'm seeing advertisements of financial advisors saying, hey, roll over your plan over to me, we'll manage it at other firms. And I see a lot of times advisors that are trying to convince these people, rather than contributing into a 401k plan, to contribute into an IRA with a financial advisor. Does that make sense?
Well, I think sometimes the reason they do it, Stewart, is because there's an element of many of those plans are very passive in nature. You're not typically going to get as good of a rate of return, or no one's really overseeing or managing it. It's more on autopilot. So quite frankly, those are some advice that I'm sure you gentlemen, make as well as myself. However, there are a lot of really huge benefits as far as your 401k plans. Get in there, understand what they are. Probably the biggest mistake I see with majority of our clients is they don't even realize that a Roth is now something that you can do within an actual 401k. That's huge. Being able to contribute to something like that. The protections that you have as far as ERISA and a variety of other things, but really understanding how your plan works and what's available and how it's going to best work with your overall planning is a real important thing.
Yeah, and quite frankly, Erick, I'm not matching anybody's funds if they put money into an IRA with us. Are you?
No. Not today.
Yeah,
Not
we
today.
can't. We can't add money.
That
So-
right there is free money.
Yeah, here's the thing, guys. It's free money. I'm not contributing into your plan, nor is any other financial advisor, which is why it's important to get that free money first. And a lot of people, I see it all the time, Scott, where they say, you know what? I wish I would have started earlier. I wish I would have done this. And we see it. They have all of these other investments, but none of it's in a Roth. It's in a brokerage account.
Yep.
It's in, in cash. And they never contributed much into their plan, but they're still working. Listen, guys, there is an option out there that makes some people uncomfortable, but I think it's worth investigating. I know we talked about this earlier today, where, Scott, some people will have the opportunity to do catch-up provisions, right? Pay more than they normally could have because of their age. And, when they do into a Roth, when they contribute to a Roth, their income gets hammered, right? Because they have to still pay taxes on the money they're contributing. But if they do catch-up, I know they say, hey, I can't afford to do a catch-up. I don't have enough income, but they've got $500,000, $1 million in other accounts that they could live off of and use that as an income stream.
Yeah, having the cash flow, obviously, we don't want to discredit that. It's important to have that. But taking advantage of those opportunities to create that tax-free growth on those retirement assets is crucial. And most people that we talk to hardly ever even talk to their plan administrators and really understand what the plans are. So taking advantage of that is very, very important.
Yeah, I just think it's important to know the limitations of your plan, to make sure that you understand how we can get the most money into a Roth if it makes sense for you. But everybody's plan is different, Eric. I think a lot of people just don't know. What else are you seeing that people are not taking advantage of when it comes to their plans?
Yeah, I mean, I used to manage 401k plans, with Fortune 500 companies. One of them is the mega backdoor Roth, right? Where basically, long story short, there's a limit up to $70,000 that you're able to contribute between you and the employer. And so long story short, you basically over contribute and then you can convert that money, put it in the Roth, right? So basically funneling more money into a Roth, where in a Roth IRA there's income limits. On this there wouldn't be, right? So there's better limits, right? Long story short, that's more of a complex strategy. So I definitely want to work with the professional when doing that. But that's honestly the number one people miss the most is the mega backdoor Roth.
Yeah, the other thing is I see people all the time that say, hey, you know what? I want to retire. I can't stand my 401k, my thrift savings plan. I need someone to watch it. I'm going to retire so I can go have it managed. But if you're 59 and a half years old, you can have it professionally managed on the outside. Doesn't make sense for everybody. Like Dan said, there are ERISA protections, loan provisions, all kinds of reasons to stay. But if you want to get an even-handed answer as to what makes sense for you, we're willing to give you that second opinion. If you want help, make it your New Year's resolution to take action today. All you have to do, pick up your phone, call 833-602-PLAN, or click on the QR code. It'll take you to assetpreservation.com. I hope you enjoyed the show today. I've enjoyed talking to you. Can't wait to see you next week. Guys, thank you so much. And let's make 2026 really count. Take action today.